What's up, everyone? It's your girl, Big Beauty. I'm your DeFi diva with an important update about FTX. But before we get into these details about the scammer, be sure to hit the like button and subscribe. That way we can continue to get updates about FTX and any other crypto coins and projects that are coming your way. And be sure to hit that little notification bell, that way you can be the first to know about these updates. So, according to Saylor, a famous Bitcoin bull and head of MicroStrategy's Bitcoin acquisition strategy, Bankman-Fried essentially borrowed money from himself since no traditional bank would lend him money at the loan-to-loan value ratio permitted under the U.S. law. Let's say you use a security as collateral when you go to a conventional bank to borrow money. You might be eligible for, let's say, a 50% loan from the bank based on 5% of the security's regulated exchange trading volume. If the securities trading volume is close to $1 billion, you could be eligible for a maximum loan of $29 million. Realistically speaking, if the bank gives a lower loan-to-loan value ratio, you would probably be able to borrow less. Bankman-Fried placed the FTX's native tokens FTT, Serum, and Solana tokens as collateral to borrow money from himself at a substantially higher ratio because no licensed bank was ready to give loans at more than 50% of the loan-to-loan value ratio. Saylor claims that Bankman-Fried committed these tokens in the amount of $10 million in order to obtain a sizable loan from Alameda Research. He then leveraged FTX client deposits to apply 20 times leverage to increase the $10 million wager to $200 million. To boost your trading investment, certain derivative trading platforms let you borrow a specific multiple of a minimal deposit. Refer to the multiple as leverage. The native tokens of FTX, FTT, Serum, and Solana were then purchased by Bankman-Fried using the leverage position to drive up their prices and boost the value of their collateral for borrowing. He then took $1 billion in client monies from FTX along with a $500 million price increase on the tokens and transferred the funds to Alameda, the former sibling company of FTX. Then Alameda gave him a loan of almost $3 billion. Low fees attracted investors to SBF. Saylor had nothing but bad things to say about Bankman-Fried and charged the bereaved ex-CEO with seducing clients and investors with inexpensive and highly leveraged trading while manipulating the price of FTX's native FTT token, Serum, and Solana. Saylor asserts that during Bankman-Fried's years at the Bahamian market, the price of SOL went from approximately $3 to a peak of $50, and that the price of FTT increased to approximately $50. Sam Bankman-Fried attempted to persuade consumers to deposit their assets, which he then treated as a pool of his own capital, as opposed to making money from trading fees like other exchanges. Saylor said that using FTX stock to give BlockFi a $400 million loan and purchase the assets of Voyager Digital was deceptive because Alameda owned both businesses' money. SBF attempted to effectively suppress allegations against Alameda by investing in stock. Since then, a bankruptcy judge in New York has mandated that Alameda repay its loan to Voyager. BlockFi and Voyager Digital both have submitted bankruptcy petitions. Social media users praised Saylor's analysis of the FTX fiasco, and one Reddit user said they found it to be interesting. Another person said that it was perhaps the easiest explanation to comprehend, while a third applauded Saylor for bringing up the fact that SBF was giving himself FTT-collateralized loans. If you want to hear more, like and subscribe.